Hello everyone and welcome back to the sessions on financial reporting. Friends, in this class of financial reporting, we are continuing with the topic share-based payment. This is the third lecture on share-based payment. In the previous class, we were discussing share-based payment to employees. Within that category, we have discussed one point that when it is a share-based payment to an employee or simply to employees, it can be classified into two categories. One where vesting conditions are involved, another where vesting conditions are not involved. What are these vesting conditions? We have already learned that. Just as a recap, vesting conditions are certain conditions that must be fulfilled or accomplished or achieved by the employee to get the benefit of share-based payment. Now friends, when it is a condition to be fulfilled, we have seen that conditions can be of two types: service conditions and performance conditions. Service conditions simply require an employee to remain in service for a continued period of certain number of years to achieve the objective. That's all. What has to be done within that service period, no criteria is given. However, the conditions could be even performance conditions. For example, if I am employer, you are employee, I would offer you share-based payment provided you achieve so much of sales target for me, or you make the company's profit increase by a certain percentage, or you achieve a certain level of profit, you make EPS to a certain level, or you put the market price of shares to a certain limit. Means I would expect my employees to work in such an efficient manner that the market price per share increases by a certain percentage. Or if I am producing a product, my objective is to reduce the cost of the product, I would expect my employees to put so much efforts that the cost reduction objective can be achieved. There can be varieties of tasks that I can place to my employee as a benchmark criteria to achieve the benefit of share-based payment. We can call these as performance conditions. So in the previous class, we have just talked about service conditions. In this class, we are dedicating the entire discussion to performance related conditions. So friends, as I said, we are into the category of share based payment to employees where vesting conditions are involved, and the type of vesting conditions that we are now going to deal with are performance conditions. So friends, performance conditions could be again classified into two different categories. One is non-market related conditions, other could be market related conditions. So some time back, while giving an example, I told you if my employees are to take advantage of share based payment scheme that I am putting across, they must work in such a nice manner that the market price of my company's equity share should rise to a certain level. That kind of condition, if I am putting, it is a market related condition. However, if I ask my employees to achieve certain level of turnover or achieve certain level of profit, it has nothing to do with the market price of the share. In that case, we can call it non-market related conditions. So friends, here the service conditions were done earlier. Today in this class, we are focusing on performance conditions, and within performance conditions, we are just going to focus first on non-market related conditions. And as you can see over here, non-market related conditions could be achieving a certain turnover level, achieving a certain profit level, achieving a cost reduction objective, and so on. So friends, the point is, there may be a situation where a service condition and performance condition can be clubbed. We are going to deal with this kind of scenario also later. Right now, we are completely focusing on performance conditions. So please understand the objective. And let me explain this by giving an example. Suppose turnover of my company is currently 40 lakh rupees. Okay, now you are my employee, I am your employer. I have asked boss, if you want to take benefit of share based payments, you must do something that sales turnover should reach or cross level of rupees 60 lakhs. So currently it is 40 lakhs. I want you to make it to the level of 60 lakhs or above. If it is touching 60 lakhs or goes beyond that, you will be benefited with the share based payment. That is for sure. So this is the criteria I have given you. Now to achieve this criteria, you will start working. Now what will happen? How many years would you take to achieve this objective is uncertain. Understand this point. It is uncertain that how many years you will take. You may take 3 years time, you may take 5 years time. We have no clue as of now. So the point is, the vesting period over here is not known. That means the vesting period cannot be considered as a fixed vesting period. In fact, the vesting period may fluctuate. Now you might be wondering, how can vesting period fluctuate? Let me explain this by giving example. In fact, let me give you that same example. Turnover of my company is rupees 40 lakhs. I have come up with employee stock option plan or employee stock purchase plan, where simply I am going to grant the shares without any consideration. But there are conditions. I am asking my employees that my turnover should reach or cross 60 lakhs. Now first year, at the beginning when I am announcing this scheme, I have no idea how many years it would take. Maybe it gets achieved in the same year. If that happens, entire provisioning for share based payment I will have to do by year end compulsorily, because this year I announced the scheme and the same year the target is achieved. So now by end of first year, what my employees have achieved, let me inform you. From the sales level of rupees 40 lakhs, they have increased the turnover to rupees 54 lakhs, correct? From 40 lakhs to 54 lakhs. They have successfully increased the sales by 14 lakhs. However, the condition was to bring the sales to the level of 60 lakhs. That means the performance condition has not been completed. If the performance condition is not yet complete, that means in the first year no vesting arises. That means vesting condition doesn't get fulfilled in the first year. But my employees, my entire sales force is confident that they will soon come up with the new policy with which sales will further increase. A little increase in sales will be enough for them to achieve their target. And they are confident that by next year the sales will cross 60 lakhs for sure. So now what we have to identify over here, in this first year the sales target could not be achieved. Fact. That means no vesting happens in first year. But looking into the scenario, it is clear that vesting will happen in the second year. That means by second year the shares will be vested. If this is clearly estimated, then we can say that the estimated vesting period is 2 years, of which 1 year has passed. So whatever be the estimated vesting value of that, half amount will be provided for in the current year. So as usual, as if the vesting period is 2 years, 1 year over. So what you will do, you will first arrive at the total estimated vesting value and you will take 1/2 of that and you will create a share based payment reserve against recognition of employee benefit expense. However, when it comes to the second year's performance, we will look into what sales the employees could achieve. Unfortunately, maybe because of some negative factor, the sales could increase only to 58 lakhs. That means a little bit of more sales would have done the task, but the sales turnover is still rupees 58 lakhs. The performance criteria could not be met. That means the performance condition is still not achieved even by end of 2 years. but now employees are very sure that next year they will do it. They don't want to give up on this. And friends, if I don't give them that freedom, they will not be encouraged enough to, work hard and increase the sales. So I keep the scheme on. I am willing to give them the benefit. I am keeping the scheme on. But now, even in 2 years, vesting could not happen. So now I am estimating the revised vesting period to be 3 years, of which 2 years have already passed. So now when I find out the estimated vesting value, the total cumulative amount that should be there in share based payment reserve should be 2/3 of the total estimated vesting value. So 2/3 becomes the new fraction. So you can see one thing, the denominator in that fraction, which in the previous year we have estimated as 2 years, now it has become 3 years. If in third year the target is achieved, you will create the entire amount of reserve and you will distribute the shares. If it doesn't happen even in the third year, then again the vesting period may further stretch, and so on until the shares are finally vested, or the scheme is withdrawn, or it is cancelled. Something happens, you will have to someday put an end to this. So what you need to understand is, point number 1, vesting period over here cannot be considered as a fixed vesting period, and that is why you have to be little more alert compared to what you have done earlier in purely service related conditions. When it was service related condition, there was a definite time period, 3 years, 4 years, 5 years, it was definite, it was not changing. So if it is 3 years, then first year you have created reserve of 1/3 of total estimated vesting value, second year 2/3, third year 3/3, task over. Here the vesting period is not fixed, and therefore this additional precaution you will have to consider. So friends, we have back to back some good questions that we are going to solve. First we will take up a very important question where the performance is in relation to increase of earnings. Then we will take up questions relating to achieving the target of cost reduction, and then we will go to market related conditions where we give the employees a specific target of achieving certain kind of market price for the shares. So but that will anyway come later. Right now let us focus on some important questions. Let us take up question number 10. Let us read this question. NJ Limited offers ESOP of 100 shares of rupees 10 each to each of its 600 employees at 1st April 2016. The employees were offered exercise price of rupees 80 per share provided the employees remain in service during the vesting period. On 1st April 2016, the market price of the share was 186. The resulting intrinsic value of ESOP was 106, that is 186 minus 80. However, the fair value of ESOP was rupees 100 per share. The shares will vest at end of the first year if the company's earnings increase by 12%. It will vest at the end of second year if the company's earnings increase by 20% over the 2-year period, and it will vest by third year if the company's earnings increase by 22% over the 3-year period. Let us move ahead in the question. It says, for the year ended 31/3/2017, earnings increased by 10% and 30 employees left the organization. The company expects that earnings will grow at a similar rate in the next year and expects that shares will vest by 31/3/2018. The company also expects that additional 30 employees will leave the organization by 31/3/2018. For the year ended 31/3/2018, the combined earnings of past 2 years was found to increase by 18%. Therefore, the shares did not vest. Only 27 employees left the organization during 2017-18. Company believes that additional 24 employees will leave in 2018-19 and earnings will further increase so that the performance target will be achieved by 31/3/2019. During 2018-19, only 21 employees have left the organization. Assume that the company's earnings increased to desired level and the performance target had been met. Required, determine the expense for each year and pass appropriate journal entries. So friends, when you are handling a big question like this, make sure that you are able to gather all the information given in the question properly. So let me do one thing, let me take you back to the early part of the question. Here, if you can see, first information which you should focus on is this point: exercise price of this ESOP is rupees 80. Thereafter, look into the next paragraph, this whole paragraph. On 1st April 2016, the market price of the share was 186. The resulting intrinsic value of ESOP was 106. So what they want you to understand is, exercise price is 80 and the market price of the share is 186. That means a share which is available in the market at a price of rupees 186 is now being offered for rupees 80 only. So one may believe that the intrinsic value of this is 106 and therefore might consider the value of option as 106. But friends, I told you this should not be the right criteria. Fair value of the option, that is fair value of the ESOP, is given to you as 100. So you will not consider this 106, you will just consider the fair value of the option, that is rupees 100. That is one important thing that you should consider. Now, there is no vesting period as such given. The shares can vest either in the first year or in the second year or in the third year, depending upon in which year the profit target or the earnings target is achieved. Now, the eligibility criteria in the first year is that if the company's earnings increase by 12%. Now, this is the condition. Let us now go back to the next paragraph in the question and let us see what has happened. If you could read this paragraph, for the year ended 31/3/2017, earnings increased by 10%. So you wanted the earnings to increase by 12%, but the earnings have increased only by 10%. Now what will happen? It is clear that the shares will not vest at this year. That is what they have given, that the shares will not vest at this year, and the company expects that the earnings will grow at similar rate. Similar rate means if it is 10% in the first year, it will be 10% even in the next year. So 10% plus 10% will make it 20%. That means the condition for the shares getting vested by end of second year will be achieved if the combined earnings of the 2 years increase by 20%. If you could understand the outcome of this whole paragraph, it is clear that the shares have not been vested by this date 31/3/2017, but the company believes that it will be vested by 31/3/2018 definitely. That means the vesting period what is expected by this date is 2 years, and we can say out of 2 years, 1 year has passed. So when you are making the calculation of share based payment reserve and the employee benefit expense, just take into mind one thing, that out of 2 years expected, 1 year has already been passed. So let us see how to present the solution. In your solution, you would first make the calculation for end of first year, and what you will do is you will compute the cumulative expenses up to the date. Now let me explain you this line very well. 600 total number of employees, 30 already left and another 30 will leave by next year. We are putting the focus only on the first 2 years because in the first year the shares could not be vested, but we expect that by end of second year the shares will be vested. So what is happening or what will happen in third year and later, we are not concerned with that. So now there will be 30 employees who have left and 30 other employees are expected to leave. Therefore by end of 2 years, the number of employees that we expect would be eligible for getting this benefit of ESOP will be 600 minus 30 minus 30, that will be 540 employees, and each one will be getting 100 shares. Now 100 rupees is what we have considered as fair value of the option or fair value of ESOP at the grant date. I told you not to take any other value but the fair value at the grant date. Then we have multiplied this fraction of 1 by 2. Why? Because we are expecting that overall period for the conditions to fulfill for vesting the rights will be 2 years, and out of 2 years 1 year has passed. So the fraction that you will multiply over here will be definitely 1 by 2, and when you make this calculation it works out to 27 lakhs less expenses recognized earlier, of course nothing, and therefore the expenses to be recognized this year will be 27 lakhs, and accordingly you will pass an accounting entry, that is employee benefit expenses debit 27 lakhs to share based payment reserve 27 lakhs. So note down this calculation and this entry, and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and make the necessary calculations for the second year. Now in the second year what we have observed that the profit target could not be achieved yet. That means we are clear that the shares will not be vested even at second year end, but we are now definitely hopeful that the shares will be vested by end of third year. So now at end of second year, the vesting period gets revised to 3 years, out of which 2 years have passed. So what we are doing, please check the calculation. There are 600 employees in total, 30 left in the first year and 27 left in the second year. And now we are expecting that 24 other employees will leave during the third year. Now we have to consider these employees' departure also, because the revised vesting period according to our new estimation is 3 years, out of which 2 years have passed. And this 100 and 100, why we are multiplying, you know it very well. And over here, the ratio that you multiply over here will be 2 by 3. And when you make this calculation, it will be 34,60,000. And from that you subtract the expenses recognized earlier, and that will be 27 lakhs. So the incremental amount of expense that you have to recognize in the second year will be just the difference between these two, that is rupees 7,60,000, by which you will pass this accounting entry, employee benefit expenses debit 7,60,000 to share based payment reserve, same amount 7,60,000. So friends, please take note of these calculations and accounting entry, and then we shall move ahead. Alright friends, you would have finished writing these calculations. Now let us move ahead with the next and last year, that is year 3. So as per the situations given in the question, by end of third year the rights have finally been vested. So what you will do is, you will make the calculations based on the actual number of employees, and what we find over here is, out of 600 total employees, the actual number of employees leaving the organization in first year, in second year and in third year. Mind it, all three are actual numbers multiplied by 100 into 100, and because the condition finally got achieved, that is the profit of combined period of 3 years is achieved, what you get finally is this ratio of 3/3, because out of 3 years of vesting period, all 3 years have been passed. When you make this calculation, it is basically the entire amount of share based payment reserve that you have to create, but out of this, the reserve already created and expenses already recognized earlier were 34,60,000, that is combined figure of year 1 and year 2. So from these two difference, you will get the amount to be recognized in the third year, that is 17,60,000, and by that amount you will pass this accounting entry, employee benefit expenses debit to share based payment reserve, and that is by 17,60,000. So please take note of this and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and now record the settlement entry, and the number of shares totally issued will be 600 employees minus 30 minus 27 minus 21. What we have subtracted from 600 employees are the actual number of employees departing before vesting of these rights, and so finally the eligible employees will be getting 100 shares each, which works out to 52,200 shares. Now on settlement, the employees will be paying rupees 80 per share. So 52,200 into 80 is the amount by which you will write bank account debit, and that is 41,76,000. And share based payment reserve will be fully debited over here, whatever you have created, and that was 52,20,000. If you would want to verify this amount, it is basically nothing but 52,200 shares multiplied by the fair value at the grant date, which was 100. So 52,200 multiplied by 100 will give you 52,20,000, and then the corresponding credit will be given to share capital. 52,200 shares of face value rupees 10 each. The amount that goes to share capital will be only 5,22,000, and the balancing amount goes to securities premium. Now friends, you should understand one thing very well. This entry, bank entry, was passed by rupees 80 per share. Share based payment reserve was created by 100 per share. So the total debit is at the rate of 80 plus 100, that is 180 per share. And here the share capital has been credited only by rupees 10 per share. So obviously the balancing figure rupees 170 per share will be recorded in the name of securities premium, which comes to 88,74,000. And friends, what I want from you is note down this whole thing carefully, and that will be end of the solution. Let us take up question number 12. Let us read this question. NJ Limited grants 100 shares to each of its 1000 employees. Fair value of shares at the grant date is rupees 64. The vesting condition is to remain in service until company's cost reduction target is achieved. That is, cost per unit should reduce by rupees 30. At the grant date, the company expects that cost reduction target will be achieved by end of 4 years. By end of first year, 40 employees left. The cost per unit got reduced by rupees 19, and the company expects that another 48 employees will leave the company and the cost reduction target will be achieved by next year. By end of second year, another 40 employees left. The cost per unit got reduced by rupees 32 overall, and the cost reduction target is achieved. Show the calculations of employee benefit expenses to be recognized in each year. Now friends, what we find in this question, again, we don't have any definite period of vesting. So vesting period is not a fixed period over here. It is simply the company's expectation that it will take 4 years to achieve a performance target, and such performance target is to reduce the cost by rupees 30 per unit. Now this target the company is expecting to achieve over a 4 years time. However, by end of first year itself, the company believes that in next year it will achieve the cost reduction target. That means by end of first year, the revised vesting period comes to only 2 years, and this was known to be 2 years right from the end of first year itself, though at the beginning the estimation was different, but we can ignore this because anyway the recognition will not be made at beginning of first year, it will be made at end of first year when this information was obtained already. So friends, when you are solving this question, what you need to do is make calculations for the 2 years, and in the first year what you would do is you will take the cumulative expenses up to the date. So try to understand the calculation basis. Out of 1000 employees, 40 actually left and 48 employees are expected to leave in the next year. Each employee will be getting 100 shares and the fair value at the grant date was 64. We have multiplied by the fraction of 1/2 because the vesting period estimate over here is 2 years, of which 1 year has passed already. 29,18,400. This is the amount by which you will recognize the employee benefit expense up to the date, that is up to end of first year, on a cumulative basis, and from that you subtract whatever you have recognized earlier. Because this being first year, we haven't recognized anything earlier, so the amount to be recognized in the first year remains 29,18,400 rupees. Now when you reach the second year and you find that the cost reduction target is achieved, means the vesting period is over. So what you will do in the second year, you will now consider the actual number of employees who will get this benefit. So first year 40 employees have left the company, that was known. In the second year also, actual number of employees leaving the company is just 40 against the estimate of 48. Actual departure were only 40. So 1000 minus 40 will be the final number of employees who will get this benefit, and the benefit will be of 100 shares per employee multiplied by 64. You may not apply any fraction over here, and if you want to apply, you may just apply 2/2 because out of 2 years both the years have been passed. So this calculation will give you total amount to be recognized in terms of employee benefit expense on a cumulative basis for 2 years, and from that you subtract the amount recognized in the first year to get the amount that you should recognize in the second year, and that will be 29,69,600. So friends, the accounting entries you know how to pass. The question did not ask accounting entries, so we are also not going to show any accounting entries. Just write up these calculations and that will be end of the solution. Alright friends, you would have finished writing this whole thing. Let us move ahead and take up the next question, that is question number 13. Let us read this question. ACC Limited granted 10,000 share options to one of its manager. In order to get the options, the manager has to work for next 3 years in the organization and reduce the cost of production by 10% over the next 3 years. Fair value of the option at the grant date was 95. Now they have given year wise cost reduction whether achieved or not. In year 1 the status is cost reduction is by 12% and the target is definitely achieved. But we cannot say that the performance condition is fully achieved, because if you can look into the question, it is asking not just the cost reduction by 10%, it is asking that the manager has to work for next 3 years and has to achieve the cost reduction target over the next 3 years. So the point is, even though cost reduction target is achieved in 1 year, the manager will not be entitled to the share based payment, because the condition is also relating to the service of next 3 years and 3 years have not got over. So you have to wait. And what happens in the second year, when in year 2 the cost reduction is only by 8%, whether the cost reduction target achieved or not, the question informs that it has not been achieved, neither it is expected to vest in the future. And by end of year 3 again the cost reduction target is achieved. How the expenses would be recorded? Now friends, in this case you will definitely recognize some amount of employee benefit expense in the first year, and whatever amount you recognize, you will have to reverse it completely by end of second year. Why? Because at end of second year neither the cost reduction target is achieved, nor it is expected that it will vest in future. That means the share based payment will not be vesting in the future. If this is the criteria, whatever share based payment reserve you have created, obviously you will have to reverse it at the end of second year. However, by the end of third year, when the target is achieved, you will again create the share based payment reserve, whatever amount is required. So friends, it can happen this way, that at a particular time during the vesting period, it is not expected that the benefit will be actually given to the employee, because the employee is not expected to complete the target. However, if the employee is achieving the target later on, you will definitely provide that benefit. Accounting has to be done on year to year basis. Therefore, by end of the year, you will have to identify very clearly whether for that year the target is achieved or not, and whether the recognition of that employee benefit expense will be made or not. If you have already recognized any employee benefit expense against a share based payment reserve and you don't expect that the benefit will be vested, then simply the amount of the share based payment reserve will have to be reversed. So let us look into how to present the solution in the given case. In your solution with respect to the first year, the usual calculation will be made, that is, you will compute the cumulative expenses up to the date, and that will be 10,000 shares multiplied by 95 into 1 by 3, because we are expecting that this is the first year passed out of the total 3 years of vesting period, and this comes to 3,16,667. No expense has been recognized earlier, so entire amount, that is 3,16,667, will be recognized in the first year. Now what has happened in the second year? When you come to the end of second year, you are finding that the target is not achieved, and now you are not having hope that the target will be achieved ahead, and therefore the vesting condition, which is to remain in service for 3 years as well as achieve the cost reduction target, is not expected to meet, and you are expecting that the benefit will not be vested. As a result, as the vesting condition is not expected to fulfill, the entire amount recognized earlier shall be reversed. So employee benefit expense for the year will be negative amount. Basically you are reversing an expense, so you will be just reversing the entry. So we have recorded the amount of employee benefit expense as a negative amount. Generally, this being an expense, you will always put as a debit. So reversing it, you are going to pass just a reversal entry. It is the share based payment reserve that will get debited and employee benefit expense will be credited. Employee benefit expense being an expense is transferred to P&L every year. When you are reversing it, it will be taken to the credit of P&L in that year. So do one thing, friends, write up these calculations and then we shall move ahead to see how to write up the calculation for the third year. But first you write this whole thing. Alright friends, you would have finished writing these calculations. So once again, let me explain one thing. This is the amount of share based payment reserve that you would have recognized in the first year, and the same thing got reversed in the second year. So by doing this, your share based payment reserve balance becomes zero, completely zero. And then when we find that in the third year the employee has achieved the target and the employee is eligible for the benefit of share based payment, you will have to again create the share based payment reserve, and in that case, because zero balance exists, you will have to record it afresh, the entire amount. So let us see how to write up that calculation. So at end of year 3, you will write the cumulative expenses up to this date, and the ratio that you have applied over here will be 3/3 because all 3 years of vesting period is over. Finally, it will be entire 9,50,000 that you should recognize, and whatever expense you have recognized earlier, the same had been reversed off. So we will consider expense recognized earlier as good as nil, and finally you will have to record entire 9,50,000 for third year. So write up this as well, and that will be end of the solution. Alright friends, you would have finished writing all these calculations. Let us move ahead and now switch to the other part of the lecture, that will be still equity settled share based payments with vesting conditions which are performance conditions, but now let us talk about market related conditions. Now friends, this part what you can find on the screen, that is performance conditions which are market related conditions. Dealing with these, it's going to be very simple, but on the same time it is very interesting. Why? Because can you understand one thing, that it is a share based payment, and if the performance condition is linked with the market price of the share, so I am asking my employees that boss, I am going to give you benefit of share based payment provided that you let the market price reach a certain extent, and I am going to make payment to you on that fulfillment of that condition, but I will be paying you in the same share. That means if share price is increased to rupees 200, you get benefit of 200. If it is increased to 300, you get benefit of 300. You put your effort, whatever be the outcome of the effort, you are the party who will be directly benefited. So friends, again, vesting period over here may not be considered as fixed. Vesting period may vary, and therefore what will be vesting period cannot be known. However, you may just plot an estimate. For example, if you have made an estimate of 4 years, but the performance is achieved in just 2 years time, you will have to make your calculations accordingly. Taking examples and understanding the scenario will be definitely helpful. So let us do one thing, let us take some small examples in the form of questions and answers, and that will guide you as in how to deal with these market related conditions. Let us take up question number 14. Let us read this question. An entity P issues share based payment to its employees based on the below details. Number of employees 100, fair value at grant date is INR 25, market conditions, share price to reach INR 30, service condition to remain in service until market conditions meet, expected completion of market condition 4 years. Define expense related to such share based payment in each year subject to the below scenarios. Number 1, market condition meets in year 3 or market condition meets in the year 5. So friends, see what you have to do over here. Let us first analyze this whole situation. There are 100 employees in the company. How many shares will be given to each employee has not been given in the question. So by default we will consider 1 share for each employee. We don't have any otherwise information available. So 1 share for each employee, and the value of each share at the grant date was INR 25, and the expected vesting period is 4 years. Basically the service condition doesn't apply. It will be only to remain in service until the market condition meet, and it is expected that market condition will meet over 4 years. So you have to answer 2 different scenarios. What if the conditions are met in 3 years, and what if the conditions are met in 5 years? So let us see how to write up the solution. In your solution, you would first find the employee benefit expense at end of each year, and that will be 100 employees multiplied by rupees 25, because 25 is the value per share, and we have considered that each employee gets just 1 share. So 100 multiplied by 25 will be the overall value of the benefit, and because we are expecting that the vesting period will be 4 years, you will take only 1/4 of that in each year. So every year you will recognize employee benefit expense of rupees 625. So now we have to answer 2 different scenarios. What if the market condition is met by end of 3rd year? In such case, at end of 1st year you will simply recognize 625 what you have considered earlier. End of 2nd year again you will recognize 625, still hoping that in 4 years time you would achieve the target. However, by end of 3rd year itself you have achieved the target. So what you will do, all the remaining amount of provision will be recognized in the 3rd year itself. So 2500, the total amount, that is 100 into 25 minus what you have recognized earlier, so that will be 1250 recognized in the 3rd year, so that in total the amount of share based payment reserve should accumulate to rupees 2500. Now what will happen if the conditions are not met in the 3rd year, not even in 4th year but 5th year? So what will happen? As usual, you will start recognizing employee benefit expense of rupees 625 each year from year 1 to 4, and nothing will be recognized at end of year 5. So basically by end of year 4 you have already recognized 2500. You cannot recognize anything more, because the share based payment reserve to accumulate only that much amount, which will be the value of the benefit offered to the employee, which works out to 2500 rupees as maximum. So nothing will be recognized at end of 5th year. So friends, do one thing, write up this whole thing, and that will be end of the answer. Alright friends, you would have finished writing this whole thing. Let us move ahead and now take up the next question, that is question number 15. Let us read this question. Apple Limited has granted 10,000 share options to one of its directors for which he must work for next 3 years, and the price of the share should increase by 20% on an average over next 3 years. The share price has moved as per below details: year 1 22%, year 2 19%, year 3 25%. At the grant date, the fair value of the option was INR 20. How the transaction would be recognized? Now friends, this is going to be very simple. Let me explain you how to analyze this. There are 10,000 shares to be given to this employee, and the value of each option over here, the fair value is 120 at the grant date. So the total value of the benefit will be 120 multiplied by 10,000 shares, and that will work out to 12 lakhs. Now the condition of service is he must work for 3 years, and then the market condition is also attached that the share price should be increasing on an average by 20%. So let us see what is happening. In the first year, can you see that the condition is met because the target is achieved. However, this alone will not be enough. You must be in service for 3 years. That is why you cannot vest the benefit in the first year. Fine, leave it. Go to the second year. So by end of 2 years, you can see 22 plus 19, the aggregate of this would be 41%. That means on an average it is more than 20% each year, definitely. And then by end of third year it is 25%. So friends, what we are observing over here, on a cumulative basis, the conditions of market price had been met each year, but finally the shares will be vested only at the end of third year, because there is performance as well as service condition both attached in this given scenario. So because the service condition is definitely 3 years, you have absolutely no doubts. 10,000 shares multiplied by 120, that will give you 12 lakhs. 1/3 of that you will recognize each year, that will be 4 lakhs, 4 lakhs and 4 lakhs. So let us see how to write up the answer. In your answer you would write up employee benefit expenses at end of each year will be 10,000 shares into rupees 120 into 1/3, that is 4 lakhs. So at end of each of the years you are going to recognize 4 lakh, 4 lakh and 4 lakh, and that would cumulate to 12 lakh rupees in total. So write up this, and that will be end of the answer. Alright friends, I am sure you must have finished writing this all. Now before you move to the next lecture, please take note of one small assignment. Now friends, I had been telling you all throughout that simply solving questions along with me will not help you. You should attempt certain number of questions on your own. So for these practice kind of questions which in your books I have marked as do it yourself, you should try out these questions first and then you should look at the solution videos for mainly looking into whether you have done everything properly or not, and to follow up a particular presentation style, etc. So friends, please note down your task. It will be question number 4, 7, 8, 9, 11 and 16. 6 questions. These 6 questions you must try before watching the next video. I repeat the number of questions, 6 questions, and which are those 6 questions? It will be question number 4, 7, 8, 9, 11 and 16. So friends, I am sure you always have been following my advices, my recommendations. This time also you will do, and let us put an end to this session. Let us declare this as end of part 3. Thank you so much for attending this class.